Let me first introduce our panelists from the SEC. Mark Cave, Associate Director in the SEC's Division of Enforcement. Mark previously served as Senior Counsel to the Director of Enforcement. Our moderator, to my immediate left, is Jason Flemmons, a Senior Managing Director at Ankura in Washington, D.C., and former Deputy Chief Accountant in the Division of Enforcement. Next to him is Jennifer Leete, partner at Cravath and a former associate director in the enforcement division for 23 years. Two down from Jennifer is Claudius Modesti, a partner at Akin Gump in Washington, D.C. Claudius's former government and public service experience includes having served as an SEC enforcement attorney, a federal prosecutor in the Eastern District of Virginia, and of course, as the first ever director of enforcement for the PCAOB. Welcome, Claudius. And finally, at the far end, John Tuttle, a partner at Debevoise and the managing partner of the firm's Washington, D.C. office and a member of the firm's litigation department. Jason, let me turn it over to you.
Terrific. Thanks, Bruce. It's really great to be here and be joined by this group of panelists who collectively have been very active in the accounting and disclosure arena, both inside and outside the SEC. This topic that we'll be talking about today really captures a significant cross-section of the enforcement program and activity, and it's been a major artery for the division for a long time. I think Gabir referred to it this morning as a evergreen priority. And we're talking about GAAP accounting, various types of disclosures, whether it be MD&A, financial statement footnotes, non-GAAP financial measures, internal controls, books and records, auditor conduct. So all of these things fall under this very broad umbrella. And the typical theme that it kind of falls under this would be, the misstatement of financial results or misleading disclosures for the purpose of inflating stock price or employee compensation or the like. So with that kind of level setting, so Mark, I thought maybe we'd start with you to give us a general overview of kind of your inside perspective on the current climate and the focus that's being placed in this arena.
Sure, thank you, and thank you for having me here today. I do have to give the standard disclaimer that the views I express today are my own in my role as an associate director in the Division of Enforcement and don't necessarily reflect the views of the enforcement staff or the commission. But just to sort of take a step back, right? I mean, Gabir mentioned earlier today about that the financial fraud and issuer disclosure component of the enforcement division's work is evergreen. It's also part of a national priority, right? You're familiar, I think, in various panels and discussions today with some of the work performed by various units. We'll talk today about cases in the financial fraud and issuer disclosure segment that were brought by multiple groups within the DC Home Office, as well as divisions or offices of the SEC throughout the country. So we'll talk about cases from Denver. We'll talk about cases from Chicago and San Francisco. Really, this is a priority throughout the division. In terms of sort of the year in review, there is. There was a lot of enforcement activity in what I would consider just sort of straight down the middle of the fairway, standard accounting fraud and other related misconduct. You saw a number of cases involving premature revenue recognition. You saw a couple of very interesting cases, I think, involving percentage of completion accounting. That's often a highly judgmental area of accounting. It can be very difficult to investigate. It can be very difficult for auditors to really effectively audit that. And so I think it's very interesting to see enforcement activity in those areas. And so it's really just sort of the perennial focus on standard accounting fraud. You saw again repeated in the enforcement activity. A couple of themes to draw out in addition to the subject areas, and this is dovetailing with something that the chair mentioned. There is an emphasis in these matters on individual accountability. In the floor matter, you saw a number of individuals charged. In the Pradium matter, we filed charges against Pradium about a year ago, a year and a half ago, and this year filed litigated charges against the CFO and CEO. Same in Mussel Farm, Austell as well. Austell's a matter that where we filed in parallel with criminal authorities, and there again you see charges against senior executives for this accounting impropriety. So standard accounting fraud focus on individual liability, and also I think demonstrating a willingness of the staff and a willingness of the commission to support charges in these judgmental areas. Another area of emphasis is on gatekeepers. That's another evergreen area of focus within the financial fraud and issuer disclosure component of the division's work. This year, charges against Markham and Crow. Again, sort of an interesting theme in these cases, and we'll touch on this at different points. Those are both SPAC or SPAC adjacent cases. When we talked last year, a common question was, okay, what do we do now with the SPAC market, right? The conversation was, look, the SPAC market is over. What is the SEC's role? And I think you've seen over the last year, both with the gatekeepers and some related matters that I'll touch on momentarily, there's a lot of work for the SEC in the SPAC market, sort of in the overhang from sort of the boom in 2020 and 2021. Both of the Markham matter and the Crow matter are worth touching on. Just very briefly, the Markham matter is very interesting in that it's not a sort of standard single audit or 2 or 3 audit, failure to adhere to the PCAOB standards. This is the sort of the core of that case was that Markham grew exponentially by taking on a lot of SPAC clients, ultimately taking on something in the order of 500 or 600 SPAC clients, growing from about 100 public issuer clients to 600 in a very short period of time. The order in that, the commission in that matter found that there were significant failures that were associated with that rapid growth. The Crow matter is a more, I think, conventional auditor matter in that, but the important thing there is that the matter there related to essentially a blown audit with respect to Akazu, which was a de-SPAC company. And there the findings are that Akazu had engaged in some pretty bad conduct itself with respect to the reporting of its revenues, but we also charged the audit firm for missing significant red flags. And I think that's just important to highlight that, with respect to gatekeepers, right, even where there is significant misconduct by the issuer client, the gatekeeper still has a role, and still has a very important role with respect to the conduct of the audit, and simply pointing to an issuer and saying, "Hey, look, there's fraud there," right? Isn't a complete and sometimes not particularly meaningful defense. We'll touch on non-GAAP later, so I don't want to get too far ahead, but you did see a number of non-GAAP cases, and I think for a lot of you representing issuer clients, that's something I know where there are a lot of questions, and so we can touch on that, so I'll move quickly past that. Staying on the theme of SPACs, you did see a number of issuer disclosure cases with SPACs recently in the Excel matter and the Hyzon matter. Those are both electric vehicle or sort of electric vehicle adjacent SPAC companies. The interesting thing there, when we're talking about SPACs over the last 2 or 3 years, one of the novel features of the sort of the going public component of a SPAC is that their issuers often felt a little bit more at liberty to make projections in a way that they didn't through a conventional IPO. What we're seeing in the recent SPAC enforcement is a willingness of the Division of Enforcement to really look under the hood at the projections that these issuers were making at the time of the de-SPAC transaction and probe the basis of those projections. And you see in a number of these SPAC matters, Excel and Hyzon included, charges that really do stem from, I think, either recklessness or negligence in some cases with respect to the projections that these SPAC companies were making. Very briefly, you also saw a number of matters that were more conventional disclosure matters, which I think some of these will come back to. And the chair touched on the McDonald's matter. Activision Blizzard was a disclosure matter involving sort of corporate misconduct and how that was disclosed. And there was a substantial penalty keyed partly off of some whistleblower retaliation claims. You saw a large settlement in one of the sort of the signature ESG matters filed by the commission against Vale a couple of years ago, settlement for $55 million there, also a disclosure case. And then finally, the last theme, and I'll turn it over, sorry, I've taken a bit more time than I intended. You see on emphasis, in addition to individual liability, like I talked about up front, also significant emphasis this year on cooperation and cooperation credit for issuers. And I think we're going to talk more about that, so I'll hold the details. But I think that's, a sort of a brief recap, year in review for the financial fraud and issuer disclosure component.
Yeah, and I'm glad you kind of ended with cooperation, because that's certainly one area that I think within the issuer reporting and accounting arena is an area where cooperation can really manifest itself. And can influence how the SEC charges a particular case or the remedies that it may seek. The SEC's website has the cooperation framework that's been out there for quite some time. It's been called a program for over 10 years or so. And we saw a number of the issuer reporting cases that cited cooperation either through reduced penalty, no undertakings, or other items. So I'm kind of curious, Jennifer, in your perspective, on the current trends with cooperation matters and any takeaways you've seen or that we should be taking away from these cases based on your experience in this area.
Sure. Well, I would just start by saying this is, of course, a perennial, another one of the evergreen issues. You heard the SEC leadership a year or so ago talk a lot about encouraging institutions and companies to cooperate. And they took a little bit of flack for not having too many examples to point to. And I think I haven't gone back to do the historical analysis, but I counted 5 cases in fiscal year 2022 in the disclosure public company auditing space that actually did have zero penalty. For the stated reason that the issuer cooperated. So that feels to me like it's a little bit of an uptick. And the other thing I've noticed is a lot more clarity in the orders about what cooperation really means. I know when I was on the staff years ago, companies would often ask to have that kind of language in the order because they like it, and we weren't able to do that many times, so I'm delighted to see the change. It really gives us a tool, me and I guess I've been doing for a year in private practice. So I've learned a lot, and one of the things is you really need tangible things to point to when you're talking to audit committees and general counsels. Why should we cooperate? Well, here's what you get. And the expanded language in the orders has really been helpful. So I thought I would just run through quickly some of the things that the SEC orders have cited. All 5 of them were self-reports, which I think is interesting. There was a lot of discussion about promptness, promptly following up on requests, promptly providing witnesses, providing analysis, identifying key documents that the SEC had not yet identified. One that caught my attention was explaining accounting issues. Accounting issues can vary from issuer to issuer. Issuer to issuer, and I understand how that could be helpful to the staff. So it feels like there's a little more traction right now with cooperation. I'm sure for each of those 5 examples, there are 5 counter examples where companies feel like they cooperated and didn't get the credit for it. So I think it's incumbent upon everyone in this room to really drill down on what cooperation has looked like. The 5 cases were Kronos, McDonald's, Stanley, Black & Decker, View, and GTT. And I think, Claudius, you handled GTT, is that right?
Yeah, we did as a firm. Thank you, Jennifer, and thank you, Bruce Carton, and thank you, Jason. So on GTT, a couple things to think about, and these types of remedial steps have emerged in other cases where there was pretty substantial cooperation credit. But one of the remedial steps is providing multiple presentations, and even though no final conclusions have been reached by the internal investigation, providing preliminary findings. It's a little bit like you're in a moving car and you're trying to stop at a rest stop while the car's still moving. It can be risky as outside counsel and as a company making that type of presentation and approach, because you and the staff may disagree at the end about what the final conclusions are, given some of the preliminary conclusions that you shared. But it's also an opportunity to engage with the staff in a timely way and in a prompt way, so they have a chance to assess as things are moving along what they may need to do. So I think that's an important distinguishing point. And then the other point were the other remedial measures: rebuilding the accounts, replacing certain members of management, board of directors, the auditor, overhauling the accounting function. I think that all went into the mix as an important factor in obtaining the type of credit the company obtained. And all of this, as many of you know, involves a lot of expense and effort. Here the company had gone through bankruptcy, it emerged as a private company, and that certainly is part of the context, I think, that you have to keep in mind.
Yeah, Jennifer, you mentioned, I guess there are many times when companies believe they have cooperated but may not get that credit, and I think there's probably less confusion about what the framework is and what the factors that the staff considers really are. But at the end of the day, you really do need the staff person in the front lines to want to give you that credit. So Mark, question to you, how do you do that? I mean, what's effective, what isn't effective when you see people come across the table and are trying to explain that we have cooperated, we have gone above and beyond?
Yeah. So I think Claudius touched on an important point with respect to timing, and I think you see both in the GTT order and in the Stanley Black & Decker order a reference to the self-report being made sort of before the issuer had ticked and tied everything. Most self-reports, this is not scientific, but anecdotally, most self-reports come within, I don't know, a few hours of the 8K. I get a lot of calls saying, Mark, I need to talk to you now. And I know why that is, right? I know that's because someone's about to push the button to file the 8K, and that's when the self-report comes in. GTT and Stanley Black & Decker are very interesting counterexamples. Now in GTT, there was an 8K that was filed contemporaneously, but that 8K was filed before the company had run everything to ground. And I think timing is very important. It's not just because it's a foot race, right? There's substance behind that. It allows the staff to get in the door early. It allows the staff to hear from counsel about what steps they're taking as part of the internal investigation, potentially to have some input around the margins, so that, and I think it also shapes the way the internal investigation takes place, right? That demonstrates a willingness to really be open with the staff about really what transpired. When you get those sort of last-second self-reports, often the companies talk to every witness, stories are straight, there's a narrative that has taken hold, and so the staff is working against that really from the jump. And so the timing is important for substantive reasons. And then on top of the timing, right, every self-report is different, but they really do vary qualitatively. But what we're looking for are, comprehensive, fair, and objective reporting on the facts as they occurred. It doesn't do us any good to see a self-report that whitewashes key documents, or that doesn't surface key documents, or that has such a narrow aperture that the staff knows from the beginning that they're going to be looking much more broadly to assess the true nature of the misconduct. So, but I think all of that starts with a commitment by the company and by counsel to truly and meaningfully cooperate. If the self-report is used as a sword, right, or a cudgel as a way of leveraging a better settlement with the staff, you're probably approaching it the wrong way. Yeah.
Well, why don't we switch gears? You had mentioned in the opening non-GAAP measures being a focus, and just again to set the table here, when we're talking about non-GAAP disclosures, we're talking about disclosures that exclude items that are required by GAAP or include items that are excluded from GAAP as a way to supplement, GAAP financial statements. And I know there's been a longstanding focus in this area by both Corp Fin and enforcement, mainly in the area of a company overemphasizing non-GAAP results over GAAP results, or in how those non-GAAP measures are actually determined. John, I know you've been recently involved in some of these matters. So what are you seeing in this area, and what are you advising your clients when interacting with the SEC?
Sure, thanks, Jason. I think, look, as you mentioned, non-GAAP is, although it was added kind of through Sarbanes-Oxley and Reg G in 2002 and 2003, it's been around, and they say even in the adopting release, for 30 years before then as a topic and as an issue. So it is something that the Commission has long been, focused on and cared about in terms of how companies describe their results, their operating and other results to the market, because oftentimes GAAP measures, everyone recognizes, aren't necessarily the most informative measures of the company's performance, particularly in certain industries. But I think what's happened recently is the Corp Fin issued some updated guidance at the end of last year in December of 22. And then that was followed not too long after by a sweep of about, I think they said about 200 letters to public companies commenting on their various non-GAAP disclosures. There have been some public ones like Lyft that had to make some adjustments to what they were presenting that had kind of negative effects on their market price and on what they were able to report. So it's been kind of high profile over the last 9 or 10 months. But if you look at the updated guidance, it's really not kind of a sea change in how the Commission has approached non-GAAP over the years. So the first thing they make clear is, look, this isn't a cookie cutter approach. It's not, although there are some clear rules in non-GAAP, things you can't do, things you have to do in terms of providing comparative information and, the most comparative GAAP measure. They said, at the core of non-GAAP, it requires, and ultimately for companies, subjects them to the Commission staff having a different view, some really subjective judgments around what is or is not misleading in terms of a non-GAAP disclosure. And not surprisingly, when you go through the guidance, lots of things can be misleading. So, talking about things like non-recurring charges and having, exempting those or removing those from the comparison without also doing the same for non-recurring gains. They're kind of saying that there needs to be an apples to apples comparison when you're talking about recurring and non-recurring. The whole definition of what is and is not recurring is something that we see a lot in comment letters, and we're seeing a lot kind of coming out of the sweep and even since the sweep in terms of what our clients are getting. And that is, there is the rule that if it happened in the last 2 years and if it's going to happen in the next 2 years, it's not non-recurring. But there's also kind of the more nuanced view of if it's something that happens periodically to you, but keeps happening periodically to you, the staff has a very firm view. I know this because we've had this discussion, that those are not non-recurring. They may not be regular, but they're not non-recurring. And so when you think about describing things like that, that is a surefire way to buy a referral from Corp Fin to enforcement if you kind of persist in that regard. There are other things that we've seen and that are in the guidance that, again, you may not think of necessarily as, and one is if you change kind of a recognition measurement in GAAP. So if, something in GAAP has to be accounted for on maybe a straight line basis over time, like a subscription, and you account for it all up front in your non-GAAP measure, that's going to be something that the staff is going to object to. If something is an accrual basis required and you present it as a cash metric, that's going to be something they're going to object to. Those are things that, that they really have now started to focus on, and I think are important to talk about. And lastly, the other thing, is just, and Jason mentioned this, prominence. you have to disclose the non-GAAP measure not more prominently than you disclose the most comparable GAAP measure. So, if you've got bold and brackets and highlights and colored ink and everything in your press release on the non-GAAP measure, you've got to have the same for the GAAP measure. Not that anyone does that, but in terms of how you do it, it's important to structure that. And finally then, and I'll turn it over to Mark in just a second, because when you do, as company, decide to present a non-GAAP measure and make it, certainly a key feature of your disclosure, you have to get it right. And you have to have the necessary and appropriate controls and procedures in place to make sure you're getting it right. And I know that because there's a really informative quote in an SEC enforcement press release by Mark Cave that in the matter of DXC Technologies that talks about a company that was exempting appropriately kind of the category of transaction and integration expenses, but didn't have the policies and procedures necessary to account for that or to make sure that what they were capturing in that category were really transaction and integration expenses. So I don't know, Mark, if there's anything you can say on DXC.
I think it's very interesting to hear Jonathan's perspective, particularly on the technical side of getting that non-GAAP metric right and sort of how you're going to interface with the Division of Corporation Finance on those issues. From an enforcement perspective, what we commonly see is that there's a collective action failure often within an issuer in getting those non-GAAP metrics right. And what I mean by that is management wants the auditor to own it, but of course it's a non-GAAP metric, so the auditor doesn't really own it. The auditor wants management to own it. It doesn't, the reporting, the calculation and the reporting of the non-GAAP metric often doesn't fit neatly within the existing control matrix. And when that happens, there are a lot of problems and there's a lot of mischief that can arise in those circumstances. And that's not to say there was a finding of mischief in the DXC matter. That was a negligence-based case. But there are a lot of opportunities for management to sort of put its imprint on that non-GAAP metric that the auditors then don't necessarily really probe, and particularly when you're talking about at the quarter, where it's just a review anyway, and you're not doing a full audit, right? And so it's very easy for there to be innocently or not miscommunications, influence on those non-GAAP metrics that ultimately result in these types of inconsistencies in the reporting that are misleading to investors.
I want to circle back. You talked earlier about the Markham case that was brought, and a longstanding topic that's been around since the PCOB was formed by Sarbanes-Oxley is the division of labor, or the combination of labor between the PCOB and the SEC. There have been some parallel cases in the past where both entities have brought actions. But the one against Markham, I think the PCOB levied a $3 million fine. The SEC levied a $10 million fine, two separate actions. And it just seems very different, to me than a U.S. Attorney's Office and SEC parallel set of cases, given the criminal and civil considerations. How do parallel actions make sense here? Claudius, I'll direct that question to you.
And then can we punt it to Mark after I'm done? It's a great question. So historically, that type of overlapping enforcement case was very much, I won't say it was out of favor, but almost non-existent. And I think the challenge in seeing these simultaneous enforcement cases on the same facts is really, what's the framework? When should we expect simultaneous actions? It's one thing to be defending your client in front of one agency, but if the other agency is simultaneously bringing a case or does very soon thereafter a follow-on case, that presents different questions about your whole strategy, how you're going to approach the respective investigations, negotiations, and the like. So I am curious how the respective staffs are thinking about that. I don't have clarity on that point. It's clearly evolving. A senior member of the SEC's OCA staff gave a speech earlier this year at an accountant liability conference, and their comment was as to auditor enforcement, when you're, and I'm quoting, when you're a hammer, the world is a nail. So that, I don't have to translate that for you. You know what that means in the auditor enforcement world. And then just, pivoting to the PCOB for a moment, they historically have been an inspection-centric organization, given the SOX requirements that they have in terms of their oversight function over firms. I think Chair Williams has been shifting that much more in the direction of being more enforcement-centric, and that creates significant questions and issues around things like, when are these inspection comments going to become enforcement cases? The trend clearly is in favor of using those inspection findings to build very quickly enforcement cases. That changes a very important dynamic for audit firms with their regulator at the PCOB. And so, that's just I think part of the mix that we're dealing with at the time. And these frameworks, I hope, will be articulated and discussed as things move along and offer a little more visibility into how the two agencies are thinking about that. But I'll pass it on to you, Mark, if you want.
Yeah, no, I think that the bottom line here is that, neither we nor the PCOB have infinite resources, and we are looking to find efficiencies wherever we can, and that means, avoiding the unnecessary duplication of efforts, sort of toward the same end. And so I don't know that, the Markham case necessarily reflects a trend that, I talked a little bit about the Markham case at the top. It's a pretty unique case in some respects, given the nature of the violations and how they came about, and the involvement of literally hundreds of audits and deficiencies, and the involvement of the national office. A national office partner was ultimately charged in that matter. So it's not to say it's sui generis, but it does present some unique issues, unique challenges, and you can see it's not hard to see from a resource allocation, resource management perspective, where it wouldn't necessarily make sense under those circumstances to simply pass the baton from one agency, or from the SEC to the PCOB, or vice versa. But I, any significant accounting fraud matter, there is these things. Well, let me back up. We are very invested in preserving resources and doing things efficiently and not creating unnecessary burdens on the subjects of or the entities that we're investigating. But the PCOB and the SEC do have their own objectives as well. They have their own sources and origins of cases, and those things all are going to factor into those decisions. But I wouldn't necessarily point to the Markham, sort of the way that those charges came about as being suggestive of a trend in sort of parallel or proceedings by the agency and by the PCOB.
So we had a few other topics we had planned to get into: internal controls, clawback, and some other things. But I promised Bruce we'd stop a little early to get back on schedule. So, 4 more minutes? Oh, well, let's get into those 3 topics then really quickly. So let's just touch briefly on internal controls. So this is an area that's evolved over the last couple of decades. Internal controls used to be an area that, it used to be that an internal control issue would be something that would not start an investigation. It'd be something that you would maybe settle down to, or it'd be kind of a secondary batch of violations attached to more severe violations. Then we went through the era of broken windows, when internal control issues did form the basis for opening cases or opening investigations. So John, and I'd like to hear from Jennifer as well, but where do you think internal control violations fit in the enforcement program today?
So I think internal controls should play an important role in the enforcement program. I think that the danger with internal controls is kind of always at the margin. So on the one end, it's not a strict liability standard. It is still a reasonableness standard. Sometimes things happen to companies where they shouldn't be found to violate the books and records or the internal controls. Usually the two go hand in hand. But usually, there are times when people just make mistakes. They have controls, they have policies, and people in judgmental areas make the wrong judgment. And I think there has to be room for that to happen. There also has to be a room between that and intent and fraud, whether it's negligence-based or scienter-based, and where there is an important message that could be made to the markets and to public companies and to financial executives that these are things you have to take seriously and there are consequences for not doing it. I get that that's an important part, but I think drawing those lines, the reason you see the changes over the last 30 or 40 years in those is drawing those lines gets to be hard, and particularly when things seem to be going in the wrong direction. I think we moved away from it. For example, after Enron WorldCom, everything had to be a fraud case for it to be interesting and for it to be brought. But I don't know, Jennifer, if you had a different view.
Well, also the expansion of these cases beyond financial controls to internal controls more broadly. Like the Activation Blizzard case, that really got people's attention. And I think it is, that's caused companies to really take a hard look at where they're weak in tracking metrics that they're reporting out and statements that they're making. So, it's really an expansion. The 13A15 charge that we're seeing a lot now, when I was at the commission, I was on the receiving end of many, many lectures from Mary Kosterlitz about how I could not throw that in because there were some controls, and that's a charge and I think the thinking on that has obviously changed, and it's having an impact.
Yeah.
Yeah.
And just have a minute left or so, but I just want to touch briefly on clawback. As most people in the room know, there were the rule changes that expanded the scope of the clawback application, to not just CEO, CFOs, but also current and former officers more generally, also not just relating to big R restatements, but also little r revisions. So what does this all mean, to practitioners and to lawyers that are advising, clients? I'll just open up generally to the panel, whoever wants to grab it. Mark, you probably have some thoughts as well. I can appoint somebody.
Well, no, sure. Look, from an enforcement perspective, it's still early days on that, right? I think the listing rules just went into effect. They were issued a year ago or so. But it still kind of remains to be seen. And I was sort of interested in hearing from the esteemed panel as to how the clients were thinking about implementing those, because it is an expansion from the SOX 304 clawback provisions that we've all gotten accustomed to. It goes deeper into the organization, it affects more of the compensation, and it's a mandatory obligation that the issuer is required to take on. That's similar to SOX 304. But it does put a lot more of the burden, I think, on the issuer client to get it right in the first instance.
I think it's early days for clients also, and it's an excellent topic for next year's panel.
Yeah, that's a good way to close. Well, thanks to my panel. Thank you, Bruce.
Thank you.